All right, hello. Welcome to the chapter on stocks. We're going to go over a couple things today on stocks. We're going to concentrate on common stocks and preferred stocks. So a couple things that we got to keep in mind when we're getting information on stocks and we're getting information really on any investment and almost anything in our life. Where are we going to get the information from? Typically, you're going to get a lot of information from whoever is trying to sell you that item, whether it's stocks, car, mutual fund, a house, etc., etc. So in all things, including stocks, we need to double check that information. Pretty much all investment advisors who are licensed, selling mutual funds, selling stocks, are going to be honest people. But then again, it's their job to sell the stock, so they are going to put the best spin on everything. So even if we're going in and we're looking for a car, and I walk into a Ford lot, and I'm looking at, say, one of their F-150 trucks or something like that, and they say this has a 5-star crash rating, it's got the highest customer satisfaction, and a couple other things, that's great information to know, and then I want to go back and double check that with another source who's not selling me something like Consumer Reports or something like that. If you're being sold a stock or a stock fund, then you want to get that information from the salesperson, whether it's Fidelity, Vanguard, or whoever. And then when you get that information, you want to go back and double check it with Morningstar or Standard & Poor's or some other agency to confirm that what they're saying is true and cast a more even-handed light instead of the best light. Okay. So we're going to look at why corporations issue common stock. Common stock is, almost by its vernacular, the most common type of stock that's out there. It represents ownership. When you talk about stock, typically this is what people are talking about, common stock. Common stock equals equity in the company. The more stock you own, the higher the percentage of the company you own. All right? And so why would companies be willing to give up ownership of the company through shares of stock? Well, first they need to raise money or start and expand a business. If a company needs to raise $1 billion like Intel has, like Boeing has to open up an entirely new manufacturing plant, a lot of times they can't go to a bank and borrow that kind of money. Maybe whatever they're going to invest in isn't going to have a great rate of return for 3, 4, 5 years while it's being built. So they don't want to be having to pay interest on that the first 3, 5, 7 years until it starts turning a profit. And so stock gives them an excellent option to raise financing, which doesn't increase the debt burden of the company overall. So some of the things that they also issue stock for, one is to pay ongoing business expenses. If you have a company that is doing this, that is a massive red flag. The same thing is if an individual needs to borrow money or they need to sell assets to get through their daily expenses. There's something wrong going on here. Unless you can really see an end to this. Like the airline industry shortly after 9/11. Pretty much air travel falls, profits fall, debt goes up. They need to somehow generate cash. Nobody wants to loan them money, and so the cheapest form of financing was issuing stock. And that stock ended up being a pretty good buy for a couple reasons. One, it was sold at a really good rate. But you knew that maybe it's 3 years, maybe it's 5 years, maybe it's 7 years, but the airline industry was going to come back. You could look at that and say this is a temporary glitch more likely than not. Also, one of the reasons that stock is issued is that while most stock pays dividends, a company does not have to pay that dividend. So if a company's paying a dividend of 50 cents per share or $1 per share every single year, and the company gets in a huge cash crunch, they can cancel that payment. If they've issued bonds, you can't just cancel payments to bondholders. You just can't cancel payments to the bank to save cash or to help you through a cash flow crisis. So stocks become very, very flexible for you. All right, so as an investor, why would you buy into stocks? Well, two things. A, you're going to get dividends from cash. Not all stocks pay dividends, but a lot do. So you're going to get cash from the dividends. Also, companies sometimes issue shares instead of cash dividends, which then gets you more shares of stock and higher equity within that firm. And so that also becomes very, very advantageous, especially if you don't need income, right? I'm several years away from retirement. I'm not looking for current income. I would rather get my dividends in stock. In fact, I would rather have the company take that money and reinvest it if they have good options and have the value of my stock grow so that I don't have to declare that as income today. That's all put off and growing later on. The other big reason is dollar appreciation in the stock. In other words, capital gains. I buy the stock at $10 today, and slowly it rises over the next 10 years to 20. Right? That's why I bought the stock. I bought it at 10. I want to sell it for 20. Another reason people buy stock is possible stock splits. This is actually an area of the book that I disagree with. Stock splits do not drive shareholder value. Stock splits have no mathematical impact on stock valuation. So, stocks that split, why do they tend to go up in value more than stocks that don't? Well, really, it's a chicken and an egg kind of thing. Companies that split their stock tend to be doing very well. They split their stock and they bring more attention to themselves. Basically, they're saying, hey, our company's doing great. Look at all our numbers, and now we're going to split. And so the company was already doing great, value's already going up, then they split and they keep going up. Companies that don't split, some of them tend to be doing very well, but a lot of them aren't doing all that great. So the last thing they want to do is split the value of their stock and draw attention to themselves. And so when we look at stock splits, typically stock splits are a means for companies to go out and draw attention to themselves when they're doing great. So therefore, if only companies that are doing great split, or the majority of companies that split are doing great, that subgroup is going to tend to outperform the market because they were doing great and then they split. It's not that they split and then they started to do great. Okay. And certainly even the book says that there's no guarantees of value going up when stocks split. Okay, so now I'm going to go over the board and we're going to do some simple math surrounding stocks and stock values to try to get you to get a handle on that. Okay, now we're going to look at some of the numbers behind stock valuations. So let's say that our company here needs to raise $1,000. And obviously, this kind of math stays the same, whether we're raising $1,000, $100,000, $100 million, whatever it is. We're just going to try to get some basic concepts here with some very simple numbers. So I need to raise $1,000. We're going to issue 100 shares at $10. And so the company predetermines pretty much what they're going to try to offer that stock at. Now, when we first issue this, the stock price might go up or it might go down depending on how the market perceives this company, whether the market thinks that this is a great value or not. So let's say that they hit it right on the nose and you go out and you buy 10 shares of this company. So I'm going to go out and I am going to buy 10 shares of this company. So I buy 10 shares at 10. So I am going to invest $100 into this company. Now when I look at how much of this company I own, I'm going to take my 10 shares. There's a total issued shares of 100. So I take my 10 shares over the 100 shares that were issued. This is assuming these are the only shares, right? We're starting our business here. If we currently had another 100 shares outstanding and this was to raise capital, then I'd be dividing by 200 here, or 2,000, or whatever the number is of total outstanding shares. But since this is a new company, this is new capital, these are the only 100 shares that exist. 100 into 10 equals 0.1, or 10% of the company. So in this instance, I own 10% of this company. I get to vote these 10 shares. Some people might own 1%, some people might own 25%. Almost all shareholders in companies own very small pieces of the company. Individuals do not buy into companies to take control of that company, right? There are some that do. Michael Dell, right, has retaken over parts of his company. Icon buys an awful lot and tries to take over the company and manage the company to increase value. There certainly are those big players out there. Most of the market is not. Even if I decided, hey, I'm going to buy $100,000 worth of Boeing stock because I think Boeing's doing really well, and hopefully they've figured out some of the issues surrounding their Dreamliner, and they're going to return to great profitabilities, which I probably predict they will. Even if I invest $100,000, if I think the company's not doing well, I'm not going to get involved with management. I'm not going to fly to Seattle and fly to Washington and lobby them on what they need to do to increase the value of the company. What I'm going to do is I'm going to sell. And so most investors, when things are not going well, they vote with their feet. They just sell and leave. And if you have more sellers, then that causes downward pressure on price, which then gets a lot of pressure on the board to then finally make changes. But here in this instance, I own 10% of the company. Let's say that the value of my company goes up. So I started this company with $1,000, and now this company is worth $2,000. Right? We've doubled the value of the company. To figure out share price in this instance, what I'm going to do is I'm going to take the value of the company, $2,000, and I'm going to divide by the total number of outstanding shares, which in this instance, right, was 100 outstanding shares. So we divide 100 into 2,000, and our stock has now doubled to $20 a share. The same as the value of our company doubled from 1,000 to 2,000. We divide by outstanding shares of 100, and we end up with a new stock value of 20. And when I sell this stock, that's what's going to be then called a capital gain. I bought it at 10. I have a capital gain of 10 to equal 20. If the value of the company went down, so in other words went from $1,000 to now it's only worth $500, I'm going to divide by my 100 into 500, and my stock now has gone from 10 to being worth $5 a share. And so the company fell by 50% from 1,000 down to 500. Same number of outstanding shares. So we divide it in, we get a $5 value, which shows my value that I originally bought in here at $10 has also dropped by 50%. If I sell this stock, this would be called a capital loss. So I lost $5 in my capital loss. All right, so I'm going to erase this here, and then we're going to go over a couple more items. Okay, so we're back. So looking at where we were before I erased the board, we got $2,000 value in the company, 100 outstanding shares. Our current value of our stock is $20. Or a company also may pay dividends. A lot of companies pay dividends. Some companies pay a lot of dividends. They pay out almost all their money in dividends. And that's why people buy that company, is for current income, for the dividends. Utility stocks are this way. A lot of the old line steel companies put out an awful lot in dividends. And so people are retired. They buy into those stocks to get the dividends. Other people don't want any dividends. McDonald's, for decades, did not pay anything out in dividends because they were growing and growing and growing. So McDonald's would make $100 million. Should they give that $100 million back to investors, or should they buy new land and develop new restaurants? Well, at the time, McDonald's was making 20-25% per year rate of return. So if McDonald's can take that and reinvest it at a 25% rate of return, I'm going to tell them, hey, you keep all that money and make me a 25% rate of return. Later on, after McDonald's pretty much saturated everything, they looked at things and said, hey, we got this $100 million. We can make a 4% rate of return. Let's give it back to investors. Because if all McDonald's is going to generate a 4% rate of return, you know what? Give me the money, and I'll take that money, and I can probably invest at a higher rate. So let's say that our company here made $200 profit after all their expenses. Typically, they're going to set aside an amount of money, just to keep things simple, of, say, $100 to reinvest in the company. New plant, new equipment, whatever it might be. That might leave $100 left over to pay for dividends. So if we look at 100 shares outstanding, into our $100, that's going to equal $1 in dividends. And so when we look at total rate of return, we need to not only include dividends, but also our capital gain. And so we started here. We've got a $20 value minus our initial investment of $10 gives us a capital appreciation of $10. We add to that our $1 in dividends, and we have a total return here of $11 a share. Now, certainly this is one heck of a great rate of return on a $10 investment, right? Most, we got 110% rate of return. In this one, mostly because the value doubled here. Most rates of return certainly are not going to be this way. Typically, if a company is issuing a good amount of dividends, they're going to have a target rate of about 5%, which means in this case, they're going to put out maybe 50 cents per share at the most. And so we need to add what our normal rate of return is. Let's say that typically the stock appreciated 8%, and we had a 5% dividend issued, then our total rate of return there is 13%. We can't look at just the dividend and say that we only got a rate of return of 5% and ignore capital appreciation. We also can't just look at the capital appreciation each year and say the company went up in value 8%, then it went up in 4%, then it went up 3%, then it went up 9%, and ignore the fact they've been paying dividends all the way along of 4 or 5% of the value. So we want to add those two items together. Okay, the last thing we're going to go over here on the board a little bit is preferred stock. Now, preferred stock is a hybrid between common stock and bonds. When someone says they're buying stock, usually we're talking common stock here that votes, that has capital appreciation. Preferred stock does not. Preferred stock has a set dividend. And in fact, a preferred stock actually acts much, much more like a bond than it does stock. And so it's kind of a tweener. Preferred stock is more risky than a bond and safer than common stock. If we're paying out dividends, first that gets paid is the bondholders, second that gets paid is preferred stock, and lastly, common stock. And so typically you'll see a preferred stock and it will have kind of a face value very, very similar to a bond or what's called a par value. It'll also have a stated dividend amount. And let's say that this one is $80. Now, the value of this preferred stock goes up and down based on the value of this $80. So when interest rates go down, the value of preferred stock goes up. When interest rates go up, then this fixed $80 has less value and the value goes down. So why wouldn't we just buy a bond? Well, typically, if a company has a bond, right, this here is yielding an 8% rate of return. $80 on 1,000 is about 8%. The bond that gets paid first might have a rate of 6%, and the rate of return on common stock might be demanding 10%. So, if you don't want the full risk of a common stock, but yet you want a better rate of return than a bond, then the preferred stock pays a fixed dividend and tends to pay a higher rate of return. So you're saying now, well, why in the heck wouldn't everybody buy the preferred bond? Well, dividend payments to the preferred stock are not guaranteed. Most of the time, we can default on the preferred stock dividends for 5 years. And if we're defaulting on the preferred stock dividend, then you cannot pay any dividends to the common stockholder. They don't get anything. And so if we're going to default here, we can default for a couple years. So we get behind. $80 we didn't pay. Then another $80 we didn't pay. So the company can conserve cash, right, and not be forced into bankruptcy. If we do not pay our bondholders, we're forced into bankruptcy. So this basically is a financing flexibility tool. And now let's say year 3, this might have been the airline industry. Airlines go through a big downturn. They're trying to conserve cash. They stop paying preferred holders. And this money then builds up. And so then year 3, lo and behold, they got the cash back. They issue me a check for $160. The back dividends I didn't receive, plus another $80 for this year, and our preferred stock is then back to being current. They can only default typically for 5 years. So what happens at 5 years? Because we can't go out, sell all this preferred stock, and then decide never to pay them. Typically what happens is preferred stock, if they do not get dividend payments for 5 years, super converts to common stock. And so it might convert at a rate of 1,000 to 1. And so preferred stockholders will then end up owning a very large portion, if not a controlling interest, in the company. And so then they can go in and make changes, and you just can't stiff them over time. Preferred stock does not vote unless it converts. And so the last thing the common shareholders want is their ownership diluted by a massive conversion where they end up with 50, 60% of the company. And so common stockholders certainly will do all they can do so that the preferred is not in default for 5 years. But it's very common as a financing flexibility tool for them to skip payment 1 year or 2 years, especially in highly volatile types of industries, airlines, transportation, entertainment, et cetera, et cetera. And so because of this, this preferred stock is riskier than a bond, and you get a better rate of return. So an awful lot of people spread out their preferred stock ownership over lots of different companies, knowing that here and there one or two won't pay for a year, but they'll probably get that money paid back. And if they can sustain that, they can get a better rate of return. If you cannot sustain payments being skipped for a couple years and you want current income, then you need to go towards bonds. Okay, and that's all we got here on preferred stock. Thank you.